Good weekend. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Friday, the 5th of June, 2020. Now remember, we're going to look at one monthly chart, and everything else is going to be weekly charts today, because on the weekend I want to give the longer-term picture and see what that might offer in the marketplace. So as we take a look at what happened today, today's not about everything behind me. This is what was the market about. The non-farm payroll and the shock. You know, I think they have 78 analysts that they survey on the Bloomberg analyst go around to see what the numbers are. They're generally pretty good too. CNBC has theirs, Fox has theirs. I saw nobody that was looking for an increase in jobs of a senior analyst. Now that doesn't mean that there weren't other people that were right on the money, and I'm sure there were some. But the market looked at what the senior analysts were doing, and the consensus was for the unemployment rate to go up to 19.5%. Instead, it fell from 14.7 last week to 13.3. The gains came in at 2,500. I expect to see more gains next month because everywhere you look, they're going to be adding jobs. New York's coming back on stream. New Jersey's coming back on. Chicago's coming back on. These are a lot of jobs. I mean, it's beautiful when you got smaller cities, but you understand what I'm getting at. These are a big amount of people that are going to come back into the labor force. So with this phase, we're hearing that. The question is, did today take the market up to some numbers that don't make sense? And that's where it gets real interesting, because at these type of gains, you're talking about an S&P that's, the PE is going to be around 24. I mean, you're getting up to big numbers where everything better go right. And that could be where the market eventually says, you know, maybe I'm a little overdone, and there could be, I don't want to use the word shock, but something not quite right, and the market backs off. In the meantime, when you get these kind of numbers, you don't stand in front of them. I think that people that were caught in the market, and it was a monster break, as we all know, from March until now, and this return, in fact, it didn't stay down that long. This is the quickest recovery of a bear market I've ever seen. And I don't think I'm the only one. I think you can talk to analyst upon analyst. The gold market gets hit on a day like today. Why? Well, the stock market's running, and interest rates soared today, by the way. They gave some of that up by the close, obviously. As you can see, the futures bounced back off the lows, but none of that's favorable to the gold market. The dollar index got a bit of a bid here because of interest rates going up and these good numbers, of course. The euro probably overdone on this monstrous run that we've had this week. But let's go and take a look first at a monthly chart. You do realize you're within striking distance now of the all-time monthly high close. You're all of at the end of this, what, 50 points away? It's nothing. Wow. I did not think this was just going to be left unchecked, okay? But I think a lot of people were in my camp. That doesn't make me right. The good news is, because the market was underneath the 18-week average of closes, I not once issued a sell signal in the market that got filled. So, very simple. On the way up, that's different. I started telling people to start buying as the market crossed that, and you got other areas in there. Why? Well, the reason was that you turned the swing line up and you're over the 18-day average of closes. It's that simple. Doesn't matter if you get filled or not, but your bias changes to the bull side. Now, when we look at the weekly chart here and we put on the swing line, which I'll do right here, you can see that you had a low, then you made a higher low here, and then another one. Now, I can show you where the problem came for me in the chart. I've got the low, higher low, everything's fine right there. I then get one of these moves where the market gets a reversal to the upside and then an outside week to the downside. If you take out the high of an outside week, it's like an outside day. My theory is you're going to go to the closest moving average above the market or the nearby Bollinger Band, the closer of that. Market goes back up, takes out that high. This is the important part right here, the week of May 22nd. And at that point, we'd had a heck of a run, but it hadn't gotten supercharged. Look at this, because this is where the supercharged came right into the market. Do you get what I'm saying? And if you put on the moving averages, you see what I'm taking you back to. This was that outside week down. Once you got up and over this, which is over that 18-week average, Well, there's no moving average above you. So what is going to be above the market? The Bollinger top. Are we going at 34.50? I don't know, but the weekly chart is friendly right now. That's all I can tell you. And support in the market, it's back right here. The 18-week average refused to have a bearish crossover so far and get under the 100-day. Fascinating how it did it. I mean, as a chartist, this is stuff that you live and breathe. And as you can see, momentum is still up. So I think that the market up here, on daily charts, you've hit a lot of the objectives. On the weekly, we still have that Bollinger top if the market wants to go there, with support at the 29.08 to 28.98 level. In the NASDAQ, did we have the same type of action? We did not. You had it in the other indices, not this one. So in this index, as we review what's going on, you had the higher lows, clearly the higher high. Now you're over the 18-week average. Unless you take out this low, I'm looking for the traders to do what? To be friendly to the market. You get an outside week up on May 8th. That means unless you take out this week's low, the market has the impetus, the way that I chart at least and teach it, to make a move to the upside. How high, I don't know, but it's got that there. And here you go. And where could we be going? Well, you can see it as well as I do. It could be the 10,244 level. That's the next resistance point. All the key averages are underneath the market. When you come to the Dow Jones Industrials, here's that outside week to the downside. So you get over it, and unlike what we were looking at in the S&P, the nearest moving average is right here. So that should be the resistance. Then you get the benefit of the 100-week being in that mess too. And then the market just supercharged itself this week. So it's hard to be anything but saying on the weekly charts, this market certainly left these lows in its wake and just came back as though none of this ever mattered. Highly, highly unusual. We've yet to see if the economy turns with earnings and the like it. But as a chartist, I don't see anything to be bearish on. And that's not a cry. It's just I don't see anything to be bearish on. The Russell has been the weakest of everything. We know there's been rotation in the markets. That doesn't mean that Amazon didn't go to an all-time high, that Apple's not going to go to all-time highs. It's not what I'm saying in any manner. What I'm saying is the techs led the market up for a very long period of time, and now we're getting the rotation into the industrials, the small size companies, the mid caps. They're the ones now coming alive. So the first resistance here makes sense at the 100-day average. The market obviously had a bear trap right here, and it first did stall. I think you'd agree with me, coming back up towards that 100, and once it could clear it, well, this is your next average. So that's where you're at. If it wanted to continue to run, 1728. Do I think it's going to? No. Do I think down the road it will? Yes. I think you've got to now chew on this data for a while. The market, I think, is ahead of earnings, and we probably won't get earnings. I know you know that. So many companies have said they're not going to issue forward guidance, so we'll have to extrapolate. When you come to the 30-year bond, we have had a downside breakout on both the weekly charts and the daily charts. I've been right on it in the dailies, and you can see this sideways action. I'm sure the Fed looks at this data. They may not look at charts the way I do them. I don't know what they're doing, but they're looking at this, and I don't think the Fed wants interest rates to climb rather dramatically. That will shut down just all this effort and all this money that they have thrown at these markets. So it'll be interesting to see this week when we see the FOMC monetary policy statement, what they say. But I, for one, would not be looking for them to get aggressive. They have the control of the market. We've had the downside breakout. The curve yield's gone back to the way that they wanted it. The redemption windows, there's nobody running there. We're not hearing that noise again. I think it's a good time for the Fed to say, let's see what happens, whatever terms they use to do that. But I'm not looking for this market to just crater. If it does, it'll be a problem for the economy. The economy's still very fragile. On the 10-year note, unlike the bond here, as you can see the weekly chart here, when I come to the weekly chart here, you're not even close to the 18-day average. You had just made it this week. You still haven't hit it at 137. I shouldn't have said not even close. You're getting close. But that doesn't mean too much to me. The momentum is broken down. The bias is up, but a close under 137 on this chart would give you then the bias down, momentum down, and obviously the swing line is down. On this chart, what you don't want to see taken out over the next 2 weeks is the high of this week. That would then be a bear trap, and it could lead the market back to the upper Bollinger Band wherever it comes in. So, interesting chart and differences. In the dollar index, I don't know that I'd get crazy bearish down here. You haven't hit the lower Bollinger Band yet. You hit the 100-week average. You extended the break. I'd be looking, just the way I talk on the daily charts, the first challenge of a Bollinger Band, daily chart, monthly chart, weekly, is often an area the market stalls at or you get a bounce away from. So between that price and right here, I'm looking, but I do think the dollar's going to be sold and sold aggressively on hard rallies. Let's see what I can get you next. Eurocurrency. If you knew nothing else, here's the market coming in. Now we know that this week, we saw the European Central Bank meeting, went very positive. We saw that Germany decided to really unveil. They went from the most austere country to throwing that money at the market, 130 billion euros, 30% more than the market was even thinking they would do. And with that, the market made a run. Now, what do I tell you? The first challenge of an upper Bollinger Band. I think the pros are taking money off the table right here, right now. That's what I think they did. That does not mean I'm not bullish this currency. I am bullish this currency, but it's on breaks and away from that area. You have to give yourself some room. Could it keep going? Of course it could keep going. Am I bearish? I'm not bearish this, and I'm certainly not bullish the dollar either, but they've gone very far. In the Canadian dollar, this too, getting a big benefit from what? Its unemployment rate did not make, just like the U.S., they too did way better today. Their numbers came out. What else? They're benefiting from oil. Oil has made a dramatic run over the past several weeks, and on that run, they're benefiting, and you can see how it's showing up. The Mexican peso had the same thing. What market's getting hit on it? Not only the dollar, but the yen. Why, if you think about it? This is a risk-off currency. What do I mean by risk-off? People typically run to the yen when they're scared that something's happening in the U.S. or somewhere in the world that things could get out of control very fast. That's not what's going on. COVID has gotten much more under control, if not under control, in most major countries. There's hot spots. India's got a nightmare, Brazil, so I'm very aware. But the U.S. is down dramatically. Asia, down dramatically. China itself, which I take away from Japan and South Korea and all that, down dramatically. And of course, Europe reopened for business. So these are the good news items, and that's putting pressure. But like the dollar, it's made its first run to the 100-week average. That could be the first support level. If it extends the break, look for the lower Bollinger Band and for there to be the support in the market that it might bounce away from. Bitcoin. Bitcoin is on a weekly basis, just in a bull pattern, staying over the 18-week average. Momentum is pointing up, bias up. If it gets another run to the upside, I'll look for this number, the let's call it 11,400 for all purposes. You don't want to return to the 18-week average. It'll take the market out of the pattern of higher lows and higher highs. The differential between WTI and Brent. Well, you would expect this week that maybe Brent would do better because they're going to be the ones taking oil off the market first. Now, we've had a pretty big run. There is going to be a number where oil's high. I'm wondering if we're not getting into that area. That is something that I'm looking at. If you look at the weekly chart, you can see how you've come up, and the market is still looking pretty bullish unless you get back through 33, 39. Momentum up, trend up, bias up in Brent. WTI, this market was a negative $40. It's now $39.55 in olive. This was 1, 2, 3, 4, 5, 6 weeks. dramatic. I've never seen anything like that. So let's understand, I don't think anyone's ever seen it go negative, and it was an unusual circumstance. And a lot of chartists, what they'll do is they'll throw this whole week out. They will remove it on the chart and just play with the others so they get rid of some of that noise. Unfortunately, I don't do it that way. I don't want to do it that way. It really happened, and I think it's important, but I realize the market has to reset from that. So we've had that vertical price rise, and maybe the market's going to come back in. If you look at XLE and a lot of the other parts of the stock, the OIH and some of the others, and I was watching Carter David today on CNBC, and he happened to be doing the oil, and he's using the 150-day average on daily charts, and you can see what he's looking at. You're coming right up to what I'd call the equivalent of an 18-day average on a daily. He's getting there on that, and he likes that as the longer-term average. Rebob gasoline, I'm looking at how the market's got higher lows, higher highs. I should have taken this arrow and put it right here. Until you take out 96.10, this market's still looking good. We know it's difficult to want to be short this. People are going to be on the road. Americans are going to drive this summer. They've been locked in 80, 90 days. They're going out. I'm not thinking they're going to urban cities. I went out to dinner last night for the first time in 80 days. Chicago's restaurants haven't been open. They just opened last night. Outdoors only. Seating, you had to be obviously away from the next table. They had it very nicely managed, and I will tell you, you couldn't get a table unless you had reservations. And if you want to go to restaurants that you know, they had to know you. So that was the important thing for me, at least. I had a great meal, and I just wanted to go out. But I see that, and I can see what's going on. Here's the interesting thing last night. Downtown Chicago, right in what we call the Gold Coast District, no cabs. None. I had to get the Uber. Normally, there's cabs everywhere. We're not in New York, but we are Chicago, and we count on that type of transportation. None. I mean, none. That was strange to me. You know, if you're interested in giving yourself ideas, maybe you second guess yourself. I certainly do. You just heard me mention Carter David. There's a whole host of people I watch. There are certain chart analysts I respect, and I like the way they do their work. It's not that I've ever met them. I have not. But I like their analysis. I like what they bring to the table. Well, you might like what I bring to the table. And if you do, I do this in a very neat way. At 5:40 in the morning, I record 40 charts. All the different, let's use that word, sectors for you of the futures markets. And I do it in a way where I'm going to give you first what went on in Asia, what's going on in Europe, what are the reports coming out in the United States? What's the estimates of the report? What time they come out? And I think that's very important. And I set you up for what the markets might be doing. Then I throw out specific buy, sell signals. If you're a subscriber, you know what I said this morning in the NASDAQ. You take a look at it and you'll see what goes on. Are all my ideas going to work? Absolutely not. It is a guarantee I'm going to have bad ideas. I think I'll give you more good ones than bad over time, but anybody that thinks they walk on water, nonsense. Everybody can get wrong. The key is money management. The key is understanding what you're doing, not breaking disciplines. So this could be a way to set you off. How do you try it? Go to our website. Go to the top, under the word research, you read right there and you sign up for it right then and there. I'm Ira Epstein. You all have a great weekend. I'll see you Monday. It's going to be an exciting weekend to see what kind of follow through, if any, we get come this week as more and more things open up in the U.S. Take care.